Good morning. My name is Jamie Nemsis, and this is the third season of Market Thinkers. This series being dedicated to everything retirement. As per usual, I'm joined by my co-host and business partner, Drew Meredith. Morning, Drew.
Hi, Jamie.
And our guest today, our very special guest today, is Mark Smith. Welcome, Mark.
Welcome. Thank you.
Throughout this series, we've talked about lots of interesting topics, topics around investments and economics. This episode is going to be more centric on what's really important about retirement, especially when you first become a retiree, which is structure, and specifically around self-managed super funds. At Wattle, our wealth management firm, we specialise in retirement. It actually took us many, many years to find this speciality, and that was not just about investments, and essentially finding a perfect mix between what is structure, investments, and for our clients, things like lifestyle, engagement, control, lots of things that, what would be seen as our competitors being industry funds can't really provide. That in mind, we've worked with Mark's group for a long time, establishing self-managed super funds, managing self-managed super funds, and controlling all the various elements. Unfortunately, I'm getting close to 50, and I've seen legislation change not just once, but at least 15 times over that journey. So superannuation is really, really important to our clients, clients in the last third of their journey, and self-managed super funds play a really big role. So I think today will be a really interesting session. Drew, do you want to introduce Mark and more about what the session will cover?
Yeah, thanks, Jamie. I think you were kind of alluding to it there that,
stole your thunder, did I?
Not quite, but when people are entering retirement or just in our lives generally, we tend to focus on the most exciting parts. No offense, Mark, working in super, but everyone wants to, what stock am I picking? What fund am I picking? What manager? What cryptocurrency? Maybe not crypto, but whereas as advisors, we see the biggest value, a lot of the value that can be delivered is, one, avoiding mistakes that people make in entering retirement, and also just making sure they're using the best structure possible. And that's where superannuation comes in. As Jamie said, it used to be 10 or 15 years of retirement. Now you're talking about 30 to 40 years. So having your assets in the best structure is very important. And I don't need to go into the three types of super, but I think there's a lot of talk that the SMSF sector specifically is getting a lot of competition or not growing as quickly. But in fact, there was a couple of articles come out today that it's growing faster than ever. So we thought, who better than Mark Smith? So he spent time at Just Super. I think you did not hundreds of thousands, but thousands of SMSF returns, super concepts, and now Neo Super. Would you consider yourself a superannuation lifer, Mark?
A lifer? I like it.
It's certainly a life term. I have been in the industry for 20 odd years. So by now, I'm certainly.
You work with Fran Horn, Mark, is that right?
I did. I picked her brains early on. I knew.
First person I ever met in self-managed super funds was Fran Horn, and she's still providing advice.
Yeah, everything I learned about pensions, I learned from her, and I still remember learning RBL.
Pre-94.
All that fun stuff from her. So she was a great asset of the business back in the day when it was running out of a little suburb out of Melbourne. So it started very small.
And there seems to be a bit of confusion that, SMSFs is subject to different laws to normal superannuation. Is that the case, or?
No, it's all there's some super funds have different requirements. Like SMSF is certainly more restricted on what you can and can't do, but no, it's the same framework. It's all governed by by the SIS Act. So
Is it worth I'm nearly 40, so not a little bit less experienced than you two. Is it worth kind of running through some of the
You bring
the
that up every day. Every single day he brings that up.
I'm 40 next year, so I'm catching. Is it worth you alluded to at the beginning, Jamie, the superannuation keeps changing. Is it going to be, should we run through a couple of those, or is it ever going to stop being the best place to put your
Drew,
retirement?
why don't you just start about what superannuation is for people that are listening to this, and we're straight into self-managed super funds. Can you, I'll put you on the spot, just articulate why in our client base, probably 85% of the money that we manage is sitting in a self-managed super fund.
I think by far the superannuation environment is the most tax effective place to have your retirement capital, regardless of, we've got a list of about 15 different changes in legislation that have happened. Regardless of those, once you retire and start drawing a pension, the majority, or up to $1.6 million of assets, becomes exempt from any income or capital gains tax. And that's just unbeatable in any entity structure. And then on the other side, once you turn 60, any income you draw from superannuation is also completely tax-free. So that's as simple as it is. You can break that down and talk about the different types of super. There's 3 types. An industry fund, everyone knows Australian Super, a corporate super fund like an MLC or a Hub24, Qantas, yeah, and then they're self-managed. So maybe I'll put back on Mark, and why do most people start an SMSF?
It just gives them that control and flexibility. So you're in the driver's seat of what the fund invests in. So if you want to buy a commercial property in the fund, you've got that right to do it in self-managed. You can't do that with an Australian super fund. So you control what the fund invests in. I think that's the primary reason people get into self-manage.
So let's just put some bookends on that. What's the range of investments? So it goes from normal bank account, you can get at CBA, to crypto's pretty
much as long as the deed allows for it. There's not many things the fund can't invest in.
Okay.
And as long as your investment strategy actually allows for the fund to invest in it. So
you use the word investment strategy there. Just maybe if we can just explain to the listeners what an investment strategy, I'm sure we've done it in a previous podcast, but what an investment strategy is, again, maybe from you, Mark, or even from you, Drew, because obviously you do them every day.
And you're a SMSF accountant, aren't you, Mark? Not an auditor?
Correct. Yep.
Yeah. So that maybe it's worth explaining what that role is and how the investment strategy kind of fits into that. So
it came enshrined in the legislation that the fund needs an investment strategy. So it needs to sort of cover the circumstances of the fund, the diversification, covers the risk profile of the fund, liquidity requirements. So what the trustees are intending to invest in, it meets the goals of what they're trying to achieve.
Yeah, I think one of the big ones there is kind of objective returns, where a lot of people start an SMSF, roll in their corporate super plan when they retire, and just start investing. I know this is a requirement for to do your tax returns and have your audit, but it should just be standard practice. When you start a fund, you should have a strategy that you're guided by. But a lot of people, I'm sure over the last 15, 20 years, you've seen a broad range of investment strategies come through.
Yes, most certainly. Mostly, pro forma strategies that, nearly every fund has, CPI increase plus 3% returns over the course of the fund. I see that a lot, but the ACO...
What gets up my nose is, these, no offense to my peers that are accountants, but the investment strategies that say cash 0 to 100, fixed income 0 to 100, Aussie shares 0 to 100, and then you go, well, the auditor can sign off on it because you're compliant because you're somewhere between 0 and 100. Surely that's not right. Surely at some point.
No, the ACO came out in the last sort of 12 months and put auditors on notice. To start checking a few things, not like investment strategies and property valuations. And they've made it clear that an asset allocation that allows 0 to 100% in any asset class is a no-no, because it's basically put no thought into what the fund's investing in.
Sure, and especially when you then have a target, right? If you've got 0 to 100 in a target, and then the trustees, which are typically the members, the two don't really add up from an investment perspective. It's a bit harder than that.
What do you've seen a lot of change from 2007 was the real big change, where we had reasonable benefits limits for 1 year when I was working, and then they were gone after that.
Please mention it again.
Are they? Not with that being political, have the changes been positive for the superannuation industry and SMSF sector?
I don't know about all the T-bar limits and all that. That's back in simple super days in 2007. Removing the RBL limits and allowing the bulk of the funds to be to go into pension mode, I thought was really beneficial. But with all the deficits in the budget, they need to put a clamp on the money going into super. So I think the latest ones are a bit more restrictive. But it is, for most of the average people, 1.6 in super should be more than adequate enough.
Hasn't hurt a lot of people though, has it?
No.
In terms of everyone goes, don't put your money into superannuation because you're subject to risk, that risk being legislation change. But and I've been advisor for 25 years. So when I look at the clients that advice of put at least 2/3 of your money into superannuation, typically pick a self-managed superannuation fund. Don't worry about the legislation because you have some money outside. No one's really been, taxed at 49% for even the ones that put a lot in there. They're still very, very concessionally taxed versus any other structure. Yep.
Very appealing because 1.6 is more than enough, and you've got your downsizer contributions that's coming recently, so you can sell your primary residence and get another 300,000 into super that's not counted towards your non-concessional caps as well. So,
and anyone that had money in superannuation, say if I was wealthy and I had $5 million in superannuation, that legislation came through. That means 1.6 would be very concessionally taxed, in pension, and the rest I could leave in accumulation, and that would only be taxed at 10% on income and 15% on capital gain, and I could pull it out whenever I want without paying any tax as well. Is that
50% on income, 10% on the capital gains held over 12 months. But
so still better than any family trust or company structure I could put my money in.
Yeah. Most certainly. We've had funds that have 40 million in an account-based pension, so they were getting huge tax refunds every year.
Not as good as where Drew keeps his money in the Cayman Islands, where he pays no tax. Yeah. Okay. Great.
And I mean, on that last comment, franking credits have been pretty popular in elections the last few times. Do you see? You got your finger on the pulse. Do you see any changes coming? Caps on franking credits.
I think
pure Labor speculation.
I think Labor tried that last time, and the grey vote certainly said a big no to that. So I don't think they would be touching that anytime soon. Just
little bits of tinkering probably will continue, and restricting how much you can get in, I guess.
Yep. So I hope there's no more great tinkering with the legislation, because it's hard to keep up with all the changes. Hopefully, once all the deficits come back into surpluses, they change the limits and try and get a bit more into super again.
So let's go back to the basics. We've said the advantages. What are the disadvantages of putting your money in a self-managed super fund versus, say, an industry fund?
The time probably required to look after your fund. I think there was a recent survey lately that it normally takes about 5 to 6 hours a month that the average trustee spends on the sort of admin work for your fund.
Yep.
So it does take time. You can delegate certain responsibilities out, but ultimately, it's a trustee's responsibility to manage the fund. So, in the past, I did have a self-managed super fund, but working late and all those hours, I just couldn't actually spend the time to actually manage my fund properly, and I wasn't getting the returns that, I
That's
was
because you didn't have a good advisor, Mark.
very true. But I'm an accountant, so I'm very tight with my money.
That's right. Yeah.
Okay, so then is there a limit? What if I've got $500,000? Is that enough to start between my wife and I? Is that enough to start a self-managed super fund?
$500,000, most certainly. So there's a recent report done by the actuary firm Rice Warner.
Yep.
And they clearly stated that a fund with over 500,000 normally has better return, or is more cost effective than an industry retail type fund. And with technology coming into the space, with sort of data feeds and AI in the sort of major software players, that a fund with only 200,000 they found is actually not that is sort of cost comparative with the big firms as well.
So that's like everything, right? So when we, again, 25 years ago when we ran self-managed super funds as wealth managers, average fee was probably about $8,500, right? So $8,500 over $1 million was 0.8%. With technology and efficiencies and groups like you've started, which is not your accountant, it's more like a warehouse type service, then costs have come down quite significantly, right? So therefore, if you thought 80 basis points was appropriate $1 million, then probably at the cost that you guys are charging, or we charge from using you guys, essentially, the amount's probably $200,000, and it still costs you 0.8%. So it is coming down. So once I weigh up the pros and cons, and I want to start a self-managed super fund, I know this is not necessarily on our run sheet, but I just need to then decide that my wife and I are the trustees, and then buy a trustee, assume off a group like yourself, and register with ASIC, and then I have my structure, start a bank account, put my money in, just make sure every year I do my financial return and my audit, and then I'm up and running roughly. Investment strategy. Is that the process?
Basically, yep. One of the sort of choices or decisions you need to make before sort of setting up is whether you go a corporate or individual trustee, but that's sort of your main one that you need to sort of consider. They're
pretty similar though, aren't they? Essentially, we would advise corporate trustees a slightly bigger fee, but on the death, we're dealing with clients in their last third of their life, right? We deal with death of a partner all the time. So
it's certainly more costly to set up initially, but the benefit in the long term with registering funds investments with a corporate trustee that won't change even if you add additional trustee directors or members in. It has its huge benefits long term. And then with the death of the member, when you're paying out, and technically, if it's a mum and dad fund, you don't need to appoint that second director in, because it can be a single director corporate trustee as well. So it has certainly got its benefits, and we'd always be recommending a corporate trustee.
Drew, do you want to talk about what a special purpose company is for people that choose to have a corporate trustee? And there's two options.
Yeah, I mean, you're creating any type of company. A special purpose company is one that has a special purpose, and that special purpose is only. I can laugh at my own jokes today. It's good. It only has a sole purpose, basically, and that sole purpose is to act as a trustee. So it doesn't have any assets of its own, and doesn't operate, and doesn't. You still have to lodge a return, but you don't have to lodge any real data for it. So it's lower cost to
cheaper, right? So the ASIC fee is what, $56 or something like that?
I think it's 59 from memory, 59? Compared to 279, I think, from memory. They keep going up, so every year.
Yeah. So a company will cost you between $600 and $1,000 to set up, notwithstanding if it's a special purpose or not. And then if it's a special purpose, it'll cost you $59 ASIC fee versus $200 and whatever, $80 or $90. If you're like me, I always forget to pay them, so it ends up being $500 or $1,000. So
I think one thing you're kind of touching on there is that SMSF's a fixed cost. So the only thing you have to do every year is lodge a tax return and an audit. There's a fixed cost to that. Anything you do after that is up to you. You can, invest in funds and pay for them. You can get advice and pay for them. But the reason it's so popular is because there's no percentage base to run it. And every, if you put it into an industry fund or into a corporate fund, they're going to charge you anywhere from 0.5 to 1.5% of every dollar that goes in. So that's where the kind of scalability and why it's popular down to 500,000 or two. There was an article in the Financial Review today that said millennials are the biggest cohort opening SMSFs at the moment because that tech keeps expanding.
And do you think, Drew, that retirees are attracted to self-managed super fund because there's more, it's absolutely transparent? You kind of contribute to superannuation. You can contribute to superannuation your whole life, but never have a real connection to it. You're not necessarily engaged. 9% of your whatever the number is now goes into superannuation. You finally get to retirement. Everyone's got a finite piece of capital, typically at retirement, that they have to live on for the rest of their life. There's a real connection that people can make between a self-managed super fund and its assets versus, Mark Delaney at Australian Super is incredibly intelligent, and their team is phenomenal, but the connection is always, one step away. It's not, so therefore, when you're trying to manage this really emotional part of your life, which you've got a finite piece of capital, it feels a bit closer. Do you think that's one of the reasons self-managed super funds are so popular in retirement?
I think so. I think there's probably tells you what the financial sector's kind of done wrong as well over 30 or 40 years, and the engagement with their superannuation has never been great. The perfect thing is we've got many clients that want to have their own ethical or environmental or social views and investing accordingly in the super fund, but doesn't matter where you go, you can never control every single investment going into it apart from an SMSF. So
you get to tailor your approach then. You get to put a filter of
if you don't want to hold BHP, or if you don't want to hold a gambling company, where you can just not hold it. And if you want to back a renewable energy, you can do that too. So it's definitely one of the biggest demands. And then cost. Anyone over a million, it's clearly all the papers say, the ASIC, the SMSF Association papers tell you that it's cost effective. I thought maybe go back to Mark on some of the biggest no-nos of SMSFs. There was a question that came through before this, which we can't answer because this is general advice only, and it was a very specific question. What are the biggest things that trip people up when they're running SMSFs?
Not providing financial assistance to any of the members. That's probably one of the biggest no-nos, and sort of early access to super.
That's like buying a property for a child in the super fund or for yourself.
Well, yeah, it's for retirement, so you've got to do everything for the sole purpose test. It's got to be long term for your retirement. So certainly need to abide by your preservation standards. So there's no early access. That's probably the biggest one on the ATO's radar. Providing financial assistance to members or relatives, and then basically if you sort of have a property, a commercial property that you're renting to your sort of family entity, that everything's done at arm's length and commercial terms. If not, you're going to be invoking NALI, which jeopardizes, that tax concession of the fund. It could, trigger a 47% tax rate within the fund.
There have been a few scams around the first point, haven't there, where people will set you up, roll you into an SMSF, help you take your money out illegally, and charge you for it. That's been a big focus in the last few years of the regulator. Massive, right?
Certainly, yeah, it certainly gets a lot of news every year that there's companies out there that are promoting it. Say it's all above board, and then you get caught out. So
we get a lot of we shouldn't say we, but when you talk about no-nos, there's lots of greys, isn't there? So we often get asked, I want to retire in 20 years' time in Sorrento. Should I buy a house in Sorrento? Because, in 20 years' time, I can sell my house, dump that house out of the superannuation fund, and then live in that. And,
the sole purpose is around retirement. It's principal residence, but essentially, where does something like that fit? And how does this, if you're a trustee, how do you test some of that stuff? Because essentially, you're in control of your own fund.
Yeah.
You're, one auditor is having a quick look once a year about how it looks, but how do you decide that if it's appropriate or not appropriate?
I'd say you probably, if you think you're going into the grey area, most certainly reach out to a specialist to make sure that you're not getting caught out by anything.
Find some affirmative advice.
Yeah, and basically, if find a beach house that later down in the track could become your retirement home, is certainly, would alert the ATO on some instances. But it's certainly an allowable asset as long as you're not staying in the premise for residential. So the auditors would be closely looking at that, checking lease agreements, checking. If it's managed by a real estate agent, because if it's managed by a third party, then it looks more at arm's length. But I have seen clients that have stayed. You can clearly see on these statements that they've stayed in the property themselves. So that's just going to sort of lead to an ATO audit and attention you don't want.
And what's the penalty for that? That's non-arm's length income or income tax?
Non-arm's length income. So taxed at 47%. Potentially, you could get disqualified as a trustee of the fund, get the fund wound down. And
47% tax on everything as well.
And then you get your trustee penalties, your civil and maybe criminal penalties imposed by the ATO as well. So, and that's on every single trustee as well. So there's some big consequences if you do some fraudulent activity.
And where's all the audit and accounting focus at the moment?
Property valuations is a big one. It's causing a lot of headaches with advisors and trustees. It's what the biggest blowback we're getting this year from our sort of clients. So the ATO sort of released guidance notes to auditors and sort of updated their property valuation guidelines on the ATO just before sort of late last year. So it was around about September, October. They updated those guidelines and it just spelled out that, in the past, you could just do a curbside valuation from a real estate agent and that would suffice for audit purposes on valuing the property at market, at current market rates. But now the ATO is saying that a curbside valuation, if it doesn't actually state your comparable sales, it isn't sufficient audit evidence for the auditors to sign off on the market values of properties anymore. So you really need to, dig a bit deeper, do your sort of research, and then, with the help of your sort of SMSF admin firm, then, potentially try and determine what a property is worth. So there's a few online sites. You can get a CoreLogic report that has those sort of comparable sales. So it's a little bit just additional work that normally, would have sufficed in, an audit 2 years ago. But that's probably the biggest noise coming through lately, and gnarly as well. So, with unit trusts, anything that's being dealt with a related party is getting special attention with auditors to make sure it's all at commercial terms. You've got documented lease agreements, loan agreements, if there's loans with related parties.
And what happens when I do my financial accounts and I have my house in Sorrento and the auditor goes, mate, you've got no rental here and you've been staying in it, so I'm not going to sign off on the audit. Do I just go?
Well, they'll sign off on the audit. They'll sign off on the audit.
Yep.
So even if you go to audit shopping, once you've engaged an auditor and they've actually started auditing the fund, even if you pull the audit later to say, all right, I don't agree with you anymore, they're still obliged to actually lodge a contravention report with the ATO, notifying them of the potential qualifications within the fund. So
I have to kill the auditor as well. Fire him.
God, Jesus. All right.
So it'll just be a Part A, Part B qualification. So you haven't complied with, or potentially complied with this, and that will just lead to an ATO audit, who will then make a determination if you have sort of complied with the legislation.
So how important is it to have a specialist SMSF accountant and auditor? The kind of stuff you just went through is another level of knowledge to have these sort of assets, is it?
It's for a vanilla fund, it's just like cash and shares. They're pretty basic returns. But if you're doing anything, starting pension, doing all that, it pays to go to a specialist because they live and breathe it. I've been doing it for 20 years, so I know it back to front. I can do it with my eyes closed. But you get to that local suburban accountant. We picked one up last week, and the financials and member statements are 4 pages long. It's going to take quite a bit of remedial work to reconstruct tax-free taxable components, cost bases. It's just not there. So if in the event something happens, like a death of the member or something, you can't give that advice because you're basing a set of financials off a tax return which has no data for you. So
is there numbers around in terms of how many funds there are and how many funds have their accounts up to date and audits? Is it?
I'm sure there are. I don't have the numbers available.
Be interesting to see, wouldn't
it? There's a lot of firms doing SMSF admin, so it is spread across multiple. There's no one big player that has the market share of doing the accounts. Plenty of firms have tried and failed because you get to a certain amount and you just lose out on service.
600,000 funds or thereabouts in Australia, is that right?
Very close, I think. Yep. And there was a big spike in establishments last year by those millennials getting to the more exotic assets that they're more risk.
A couple of real world examples, or have you got another question, Jamie?
I always have 100 questions,
especially on super. I had a couple of I think I put a couple of examples in the preparation sheet of one of the big benefits of superannuation is flexibility, whether that or SMSFs is flexibility, whether that's contributions, pensions. One common question we get is around rollovers into and out of SMSFs.
A lot more complicated now with SuperStream, so that's another reason why if you have a dedicated SMSF administrator, they can assist with that because to initiate a rollover now, it's got to be done through SuperStream. You can't do a paper rollover statement, so you really need sort of dedicated software to do that now.
And so does that involve repricing assets or getting the value of the fund?
So if you're doing any sort of benefit payment, you need to have up-to-date figures. So you need to know what the member's balance is the date before the transfer. So most of the time
they call provisional account. They used to be called provisional accounts, or is that?
We just call them interim accounts, basically.
Okay. So interim to establish the member balance, and then there's a system to roll that money to whatever super fund you want.
Yep.
So it's a little bit harder than rolling out of an industry fund, but you can still do it.
Yeah, we just prepare a set of financials up to the date, basically. So we do half the work or a quarter of the work before the end of year and just strike the earning rates and then prepare the documents. So it just needs a little bit of coordination between your firm and the client. So if you are sort of intending to roll out of a sort of industry fund to your SMSF, sort of reach out to your administrator because there are sort of penalties for delays in doing that notification via SuperStream. So if we do need to pair interim accounts, we need to have that up to date before we sort of do that messaging system through the software to say, all right, we're ready to do a rollover. Can you pay the money or pay the money out to an Australian super type entity?
So this is the problem when you use an accountant and he or she has 25 self-managed super funds, then it's really, really specific, isn't it? And technical. So you have to pay your advisor, your accountant to learn how to do it rather than, use a group like yours.
Yes, you could pay thousands of dollars just to do that where, it doesn't really cost anything extra with us. We'll just do it for you because it's just part of the normal accounts.
Yeah, and I'll go a couple of questions. Can you buy stocks and funds from yourself? By the super fund?
As long as it's sort of widely held and listed securities, you can certainly buy an ASX shares from yourself and transfer them into your super fund as long as it's at current market rates. So you're not buying like see sold from yourself for $10 or anything. So you're not trying to minimise any capital gains and get the benefit into it. So yeah, as long as it's at market rate, you can sort of buy, you know, your ASX shares from yourself and transfer them into the fund. And likewise, you're going to always buy it back off the super fund if you need be.
And excess contributions tend to be popping up a bit more regularly, I think, just because there's been so many changes. The current limits, Jamie, what, 27,500 for concessional and 110 for non-concessional.
Yep.
Is there flexibility around, you know, allocating if you've over contributed?
Potentially there is some things, but you know, with like it really depends on things, because you know, typically once a contribution is made, it's locked in. But you know, if you made a non-concessional contribution, depending on the, you know, transfer balance account balance of each member, I think you could move it across from, you know, the husband to the wife if they're sort of bring you know, the non-concessional caps have been triggered or exceeded.
And could you comment on reserving strategies as well?
So yeah,
I think I've used them once in 20 years.
we have one advisor that has about 10 of them in their fund. So it comes in well, but once you use it, you need to use it nearly every single year, because then you brought forward those contributions from the next year. So I'm not sure the full benefit, but yeah, if you've slightly gone over your contributions in 1 year, and the contributions made in June, within the legislation, you need to allocate it within 28 days, a month following the contribution. So it's really only to allocate any contributions received in June, you could put in a reserve and allocate it to the member in July the next year, and that means it's still taxed in the fund say it was in June 21, it's taxed in the fund in June 21, but it counts towards their concessional caps in the
year after.
in the year after.
And you'd get the tax deduction if it was concessional in your own name in the previous year too, wouldn't you?
So the company can claim the tax deduction. So yeah, they could put in, I'll say the 50,000 because I can't be bothered working out the other one. So yeah, they could claim 50,000, or in their member personal return, you know, they could put in member concessional 50,000 if they've got a large capital gain in that 1 year to minimise their tax. So there is certainly strategies, and it comes into play.
What's the weirdest asset you've ever seen in a self-managed super fund?
Crypto.
It's mainstream asset now, Drew. Wine.
I've seen wine in there. Comic books
Mine would be empty bottles, not wine.
They're probably the main ones.
Comic books.
And yeah, just sort of
collectibles are allowed, aren't they? You can do you could do art, can you? Yep.
You can, but yeah, there's still sort of requirements that it can't be stored on you know, in your sort of residential premise. It needs to be stored off site. It can't be on display unless it's you know, if you are leasing it from yourself, then it needs to count within your sort of in-house asset rules. So your 5% limits, which don't really come into play as much as it did in the past. But
what about rare cars? I've always wanted a 1972 Dino Ferrari. Can I put that? Sell my Sorrento property and
need some more in your super fund.
Yeah,
I did have a client that had it was a MG, I think it was. But with those, you can't actually drive it at all. Not even to take it to your local mechanic to get it.
Is that right? Yep. It has to be in a museum or a storage.
It has to be storage, and yeah, you can't drive it ever. So I think the temptation is too great to have those in there. But yeah, I do know of one client that's got it. It's stored at you know, a garage, and yeah, the audit requirements. You're going to sort of get particular attention from the auditors every year. We have one client with gold bullion. He has a lot of gold bullion.
Like the Perth Mint, or in his backyard?
Yeah, Perth Mint. So he's got his stores that has been fault. So every year I ask the question to confirm you still hold it. So yeah, give me a photo of it with today's paper and show me every single gold bar, because he has
a lot of it.
A lot of it.
I like him.
And that's priming his investment strategy, gold bullion, and a small percentage in cash. That's his entire fund.
He's worried about inflation.
And all I'm getting is queries about crypto at the moment. Not that we recommend it, but I had a question in the run sheet about can you hold it in SMSF?
You can, certainly, and it's becoming a lot more popular. Like 5 years ago, I had one fund that had cryptocurrency. He did lose quite a bit of money in it because he got in just as it went bust. So he did lose a bit, but yeah, most certainly can hold cryptocurrency. Just need to be mindful of that the investment needs to be registered in the name of the super fund, so it can't be held in your name personally. So there's a few exchanges in Australia that do allow for the registration to be set up correctly. And then, you just need to sort of figure out that the funds are audited, so make sure they do have reporting, or you can sort of subscribe to a sort of a wallet or reporting system that can track all your trades, your gain and losses, and your sort of portfolio valuations. And it could potentially mean your admin fees are a little bit more expensive if you're trading a hell of a lot, and we can't sort of get a sort of data feed on those sort of transactions.
Great. I think that's our run sheet. Is there anything else you wanted to add, Drew?
I could go for another, as Mark knows, another hour and a half. So I think it's good to have this as a nice intro catch up, and then we'll tailor the next series around even
specific issues,
more
complicated. So
and welcome any questions.
Appreciate your time, Mark. Obviously, we've had a long association with you and Stephen, and it's been a very successful one. So appreciate you giving up your time and listening or contributing to this podcast. Really beneficial for us and beneficial for the readers. So on behalf of Drew and I, thanks very much.
You're very welcome.
For all listeners, that's the conclusion of this episode in Series 3. Please join us for the next one. Drew, do you have any? I don't know who that is.
We have the team from Barwon Investment Partners talking about healthcare property on Friday morning.
Great. All right, guys. Thanks very much.
Thanks.